Welcome back, everyone. This is Sean with the Finance and Tech Exchange, along with Viviana, here to talk to you about everything from tech to finance, making it make sense for your business. And we're continuing our conversation this week with a great topic in as far as finance is concerned. What is the topic for this week, Viviana?
Yeah, so today we're talking about separating business and personal finances and for real this time.
Oh, okay. So seriously this time.
Yes, most business owners go out there, they form their LLC and they feel they're protected. But the thing is, nobody else tells you that every time you go to a store and you buy items in your business for you personally, you're creating a problem. And that's what we want to talk about today.
Okay, great. So let's get into it here and let's see why this is really important because I do think that, especially when you're a W 2 employee and then you become a self entrepreneur or business owner, that's something that you kind of have to figure out and learn yourself, right?
I think a lot of people think, okay, I'm the one owning the business, so I'm entitled to do whatever I want, right, with the business. But when you legally open a business, there are certain things that it become applicable to you at that point. And a lot of times, what happens is you want to treat your business as your personal account. So you start making these small decisions, like when you go to the groceries, when you go to Amazon, and you just start treating your business as your personal account with the hope that the purchases that you're making can become a tax deduction. That's where the problem began. So it's a small decisions that become like a big snowball effect.
So, but what's the big deal if you do happen to mix a little bit of personal expenses with your business? I mean, is there something really that stands out that's gonna be a big negative for you long term by doing that?
Yeah, there are three issues. The biggest one is tax problems. Essentially, you are creating an IRS audit ready to happen when you do that. For a business expense to be eligible, it has to have a business purpose. So and it has to be reasonable, it cannot be extravagant, it has to be for a legitimate business expense. So when you're using for personal expenditures like going to Disney, going to a cruise, all these things, you're essentially creating a problem in your books. And if the IRS comes and out of your books, you're going to have issues there. That's reason one. Reason two is that your numbers are going to stop telling the truth because then you're not really going to understand and see whether your business is actually being profitable or not because you have all these expenses that you have personal business. So are you actually being profitable? Are you actually pricing your jobs correctly? So I would say that's the second one. You're not going to have clear information to make good decisions. And the third one is the one that most business owners have not ever heard of.
So, what is that risk that you're referring to that businesses never heard of?
Yeah, so I'm not an attorney, so this is not legal advice, but I do want to explain the problem that can happen. So when you open a corporation or an LLC, you doing that because you want to have legal protection. So I like to say this like you essentially purchase an umbrella, right? So that when you have an umbrella
Mhm.
and it's raining, you don't get wet, you can protect it. Same thing, you have a business, you want to be protected. Now, what happens every time you run a personal expense to your business, you're making a small holes in that umbrella. Maybe you don't notice, right? It's little smalls, but then once there's a big storm, the umbrella is not going to protect you.
Mm,
So,
okay.
in business terms, that's called piercing the corporate veil. So essentially, when you're mixing personal with business, you're piercing that protection And if you ever get sued and they take you to court, they can look at your business, and if they find a pattern, they can essentially determine that you don't have that protection anymore. That's the issue.
Okay.
Again, we go back to the problem is not that you can take the money out of your business to pay for your personal expenses. That's not the problem. It's a problem is how you take the money out. So I'm gonna again, and this is I want you as a business owner, if you're a business owner, and especially this is a problem with those that are starting. Although I have seen owners that are 5, 10 in year in business, and they tend sometimes to forget this. But again, it's how you take the money. So depending on how your business is set up for legal purpose and for tax purposes, the IRS has provided like a guideline on how you pay yourself. So I just want to give you an example. And again, you want to go check with your tax professional and make sure that you are taking out the money according to how your business is set up. But I'm just going to give an example, like say an S corp. If you're an S corp, there's going to be the way you're taking out the money is going to be a mix between payroll and shareholder distributions. So that's how you want to take out the money. You want to show, okay, I pay myself a reasonable salary, and then every month I'm going to take a distribution from the business to my personal expense. And you want to write it as such distributions. Now, from there, you can use the money however you want. That is the right way. Now, the wrong way is to use a business card to go buy a Disney ticket, to go buy personal groceries, to go on a cruise, to go to Victoria's Secret, things like that that are clearly intended for personal use. Those are the items that will create a red flag in your business. Now, there are ways also that you can reimburse yourself, and there's some tax planning opportunities for like the proper use your home office, your personal vehicle. There are ways that you can use some of your personal um, expenses that technically there's a percentage that can apply for business use. But again, there's a lot of IRS regulations and the right way to do it. So that's why it's important that you talk to your tax preparer so they can create a plan with you and they can guide you on how to take the money properly from the business.
Okay, so if I want to, I'm gonna think about it, an example here. I want to buy a ticket to, like you mentioned, Disney, or I want to get myself a new set of golf clubs. Then instead of using my company credit card, I would use my personal credit card and then use either payroll or distributions from the company to pay that credit card, my personal credit card.
Exactly. If you are, an escort, right? And again, that's kind of where I want you to have a conversation with your tax
Okay.
preparer, with your accountant too, so they can explain you the proper way. Because depending on how your company is set up for tax purposes, that's how you're gonna get paid.
Yeah.
If you're an LLC, a single member, you're gonna take draws from the company, so you wanna document those as such. But yeah, the idea is you want to protect what you're building, protect your business, keep that legal protection, don't make holes in that corporate
Corporate.
veil.
Yeah.
Yeah. And that way you're protected legally. And two, you have clear understanding of how your business is performing because everything that you see there, every expense that you see from in your business is actual business use. And then that way you can track how much money you're actually taking from the business the right way.
Nice. Okay. I appreciate the explanation there. So what should our listeners walk away with from this topic?
One, please have a conversation with your tax preparer, tax professional, accountant. Make sure that you are taking money out of the business the right way. Two, don't forget that every personal expense you run through your business credit card is making holes to that legal protection that you have, right? That's the biggest one. Don't overlook your legal protection. You want to keep protected. And three, remember that if you have good records, you're going to be able to make good business decisions.
Okay. Good info. Appreciate the very simple explanation. I think I got a good thing to apply and talk to my tax professional for some guidance there as well.
Yeah, and if you don't if you don't have a tax professional or someone that you can talk to this, that's why I'm here. Reach out. We have all my information in the description notes. I'll be happy to walk you through that and make sure that you have a good financial system set up and that you understanding your numbers.
Perfect. All right. Well, that wraps it up with our finance discussion. If you found this information useful, please share it with other business owners you may know. And next week, we'll be continuing with a different topic. What's the topic for next week? See, I'm just looking at my show notes. Excuse me.
Let me see. Oh, this is a good one. Yeah. So the next one is when to hire a CFO versus when to hire a bookkeeper.
When to hire a CFO versus when to hire a bookkeeper. That sounds like a pretty deep topic.
Yeah, that's gonna be a good one.
All right. Well, look forward to hearing it. Thank you all for joining us for this discussion, and we look forward to seeing you on the next one. Please like or subscribe if you found this information useful. That way, we can continue providing this content. Thanks again.
Bye.